2025 was a roller coaster year for VC. Deal counts rose, multiple high-profile IPOs dominated headlines, and AI attracted a record amount of capital. But for startups outside of these standout examples, VC's momentum never picked up, largely due to macroeconomic volatility from tariffs and the government shutdown. As we head into 2026, optimism is cautiously returning. Deal activity is growing again at every stage, with first financings and early-stage rounds nearing 2021 highs. However, here's the tension. Half of all venture dollars went into just 0.05% of deals, highlighting a significant imbalance in the market. The obvious driver of this concentration is AI. In 2025, AI accounted for roughly 2/3 of all deal value and nearly 40% of deal count. Companies across every sector are racing to adopt AI before they get left behind. The technology's massive capital requirements mean that founders are raising enormous rounds before revenue even exists. Because of the growing size of venture deals, large investment firms with deep dry powder are propping up the market, especially at seed and early stage. This concentration is also showing up geographically. In 2025, the Bay Area alone captured over 54% of all US VC deal value, which is the highest level ever recorded. Plus, 14 of the 20 largest deals came from that single ecosystem. Now let's talk about exits, the missing piece of the recovery. Yes, 2025 brought momentum, 17 unicorns went public, and exit value reached nearly $300 billion. But it still wasn't enough. Unicorn valuations are now more than 6 times higher than in 2019, and the market needs far more large exits to truly fix the liquidity gap. Most IPOs in 2025 shared one thing in common. They align closely with policy-favored sectors: AI, crypto, space, fintech, and national security. Despite massive first-day price pops and investor enthusiasm, many stocks struggle to hold their gains, and nearly every large listing of 2025 is trading lower than its first-day close price. The IPO window cracked open, but it didn't fully reopen. The one consistently bright spot in liquidity has been secondaries. By Q3, the US VC secondary market reached nearly $95 billion in annual value, becoming a critical source of liquidity when traditional exits fall short. And that brings us to fundraising, the slowest part of the recovery. Only $71 billion was raised in 2025, and the number of closed funds hit a decade low. LPs are still dealing with negative cash flows, unfunded commitments, and portfolio imbalance. So here's the takeaway from 2025. Venture is recovering, but not evenly. 2026 won't be a full rebound, but we are cautiously optimistic that the year will lay a solid foundation for venture's comeback.